Silver doesn't move because the system panics. The system panics because silver moves first. Every major financial stress in history followed the same order. Silver reacted, institutions denied, and only later the system admitted there was a problem. Welcome to Wheelixon, where history isn't just remembered, it's used to understand how money, power, and systems quietly break. When people see silver rising, they assume speculation, charts, traders, momentum. But applied financial history shows something far more important. Silver is not a prediction. Silver is a reaction. And historically, silver reacts before the financial system admits stress. This has happened repeatedly, not once, not twice, but across centuries. Because silver sits in a unique position inside the system, it is both money and necessity, both store of value and industrial input. That makes silver sensitive to pressure long before headlines change. In periods of real stability, silver behaves quietly. It follows paper markets. It respects futures prices. It responds to incentives. But when stress builds beneath the surface, silver stops listening. Not loudly, not dramatically, quietly. Why does this happen? Because silver lives in the physical world. Gold can sit untouched in vaults for decades. Stocks exist only as claims. Bonds are promises. Silver gets used. Once silver enters electronics, energy systems, or industry, it doesn't come back. That makes silver unforgiving. You can roll debt. You can extend promises. You can print liquidity. You cannot print silver. History shows that whenever systems rely too heavily on paper promises, silver reacts first. In the late 1960s, before the gold system broke, silver demand tightened. In inflationary periods, silver moved before currencies adjusted. In moments of industrial stress, silver premiums appeared before official shortages. Silver doesn't wait for permission. Modern financial systems assume something dangerous. They assume paper and physical are interchangeable. As long as that belief holds, markets function smoothly. Futures settle. ETFs track price. Arbitrage closes gaps. But when physical demand stops respecting paper prices, the illusion weakens. That's what silver reveals. Not shortage headlines, not panic, belief erosion. When participants begin asking simple questions, will delivery arrive on time? Will settlement stay smooth? Will paper still represent reality? Markets start behaving differently. Silver is doing that now. This doesn't mean collapse is imminent. Applied financial history is not about alarm, it's about sequence. First, behavior changes, then confidence adjusts. Only later do narratives follow. Silver is in the behavior phase. Notice how explanations sound today. Temporary imbalance, retail-driven demand, seasonal effects. These phrases don't explain mechanics. They manage perception. History teaches us something important here. When systems fully understand a movement, explanations are calm and specific. When systems are uncomfortable, explanations repeat. Silver explanations are repeating. Another key sign is the absence of panic. People expect stress to look chaotic. It doesn't. Early-stage stress looks boring. Premiums widen slowly. Physical buyers secure supply quietly. Flows move without headlines. By the time panic appears, positioning is already complete. Silver always moves before permission is granted. This is why silver matters more than price targets. Price is noise. Behavior is signal. Silver's behavior tells us that parts of the system are prioritizing availability over price. That is never a trivial shift. Historically, when availability matters more than price, systems are under strain. Not broken, not collapsing, but stretched. And stretched systems reveal themselves through assets tied to reality. Silver, energy, food, not derivatives, not narratives. Silver is not causing stress, it is measuring it. Just like a thermometer doesn't cause a fever, silver doesn't cause financial instability. It reveals where pressure already exists. This is why silver always moves first, not because it's smarter, but because it's honest. It responds to reality, not reassurance. Understanding this removes fear, because this isn't chaos, it's process. And processes can be studied. Applied financial history doesn't ask, how high will silver go? It asks, why did silver stop obeying the old rules? That question matters far more. When silver stops responding to paper incentives, it tells us trust is being repriced. Not eliminated, repriced. And trust, once questioned, doesn't return easily. Silver doesn't shout, it whispers. And history shows that whispers always come before announcements. If you want to understand money before headlines admit stress, subscribe to Wheelixon.